Hello, ladies and gentlemen, and welcome to our interview with Jordi Pujol. Jordi is from Objective Investment Banking and Valuation, and he is an appraiser by trade, a CFA chart holder, and holds an MBA from the Wharton School at the University of Pennsylvania. He is a finance expert and has been working on multiple sides on valuation for over a decade. Jordi also a managing director at Objective and a true enthusiast in the realm of business valuation. So Jordi combines a deep understanding of finance with an approachable manner, making the often complex world of business valuation accessible to all. So Jordi, thank you for joining our Risk Management Show podcast today.
Thank you so much, Boris. Thank you for having me. Hi, everyone. So you're right. What I like to talk about and write about is the obvious yet not so obvious lessons from financial theory that can be applicable in everyday business life. So I've been doing valuations since the last financial crisis, and I've done valuations involving companies from anything such as a small preschool all the way to billion-dollar acquisitions by Fortune 500 companies where we've had to value their acquired assets. So today, I have two important concepts that sometimes get forgotten amidst the everyday necessities for business owners. And they are tools that are financially driven, but that can help you mitigate risk within your business.
Fantastic. So the topic of our conversation will be importance of forecasting. How can companies de-risk their operations from a financial perspective, and also why is risk management so important for value creation, right? So Jordi, could you tell us firstly a short story about your career path, what brought you to where you are right now, and what you guys at Objective are up to this day?
Yeah, absolutely. So in a very short fashion, I started my career at the Citi Private Bank. So my first internship was in private wealth management. Very quickly, I realized that I wanted additional technical skills. And so I joined a team that provided equity research in the media and entertainment industry. Fantastic experience. We got to see Disney acquire the Star Wars properties and a lot of growth and change in the media and entertainment industry. But I then moved to a sell-side M&A team. So that's performing sell-side services for companies that are looking to sell their business. It was regional M&A, a very interesting mix of companies, supermarkets, milk producers, a lot of very interesting businesses. And then when I moved to Los Angeles, I joined a business valuation team at Ernst & Young, which specialized in public companies and large asset managers. So I did a lot of valuations of intellectual property, including technology and customer relationships, brands, as well as a lot of investment type valuations, meaning private equity investments and venture capital investments.
Fantastic. So let's just do some introduction. Why forecasting is important, why lower risk means higher value, and what are some common financial risks that companies face in their operation?
Yes, absolutely. So the first one for me, I try to state this in a simple manner, which is you wouldn't typically drive without a map, right? Yet a lot of companies are growing their business, and because they're doing so many things at once, sometimes forget to put things on paper and create a forecast of where they're going. So again, the idea is to create a roadmap, a blueprint of where you're headed to, so that you can understand what's going to happen in the next quarter, what's going to happen in the next year, and what's going to happen in the next 3 to 5 years. You don't have to be perfect about it, but you at least should sell yourself the strategy and the long-term plan that will get you to the place you want to be.
Mm-hmm. So do you have some examples of what you did and how what tools did you use in your forecasting work?
Yeah, absolutely. So I was part of a forecasting team that was trying to help a healthcare client understand their growth potential. They sold patient engagement tools and were primarily focused on hospitals. The problem was that when we put everything on paper, there's only so many hospitals that you can sell into. I think in the US, it's something like 4,000 hospitals that are available to sell into. That's the total market. And so what we needed to first do is understand all of the adjacencies to that market. So instead of just forecasting for hospitals, we helped them understand, can you sell your product into local clinics? Can you sell your product into independent physician practices? Could you even consider dentist? In that way, they could understand how their business could grow, not only in that core hospital business, but also in all of the surrounding adjacencies, and recover all of the R&D that they were putting into it. That's a very simple example of how, something clicked for them, and they were able to very quickly realize that if they just sold to hospitals, they were not going to recoup their investment. And at the same time, they realized that it's not so easy to sell into an independent dentistry practice. It's really not the same at all as selling it to a hospital. And so by forecasting, they actually decided to start outside of hospitals that have much longer sales cycles and sell to the small ones, proving their concept.
Mm-hmm. And what are some real tools, for example, let's say when you want to expand by growing inorganically by buying businesses? Are there any specific tools from your experience?
Yeah, so that's, again, something that you can typically do before considering even buying a business, right? Again, put it on paper, understand how that business is going to not only create value on its own, but perhaps have synergies with your own operations. Deal models are a very common thing in M&A, but a lot of the time they're done quickly. They're done in a manner that perhaps doesn't forecast from a bottoms-up perspective, or that may not have all the conversations with your business unit owners or even the managers of certain business lines. And the idea is always to create better business models by involving professionals that have done hundreds of deal models in the past. They can really help you uncover the tips and tricks of modeling. They can help you do scenario analysis. They can help you do sensitivities in your forecasting. And that's really helpful because you can plan for the best, but always be protected if the worst comes to fruition.
Mm-hmm. And as for smaller companies or newer companies with limited resources, how can they approach risk managers in a cost-effective manner?
Yes, absolutely. So something that I realized in the market when I changed to objective is that there are providers for every tier of business. You have, your McKinseys and your Bain and BCGs of the world that deal with strategy with very large corporations. You have the Big Four dealing with implementation and a lot of technical accounting and technical financial modeling. And then you have middle tier providers that have those expertise, a lot of the people trained at those bigger companies, and can provide businesses for the middle market. On top of that, you have a lot of independent providers and small boutique investment banks like ours that deal with smaller companies. So because I don't have any restrictions on the types of clients that I can offer my services to, we can work with limited scope engagements where I just help with one area of the forecasting, for example, just a revenue line. We can tailor our scope to include just a financial model. We can include valuations. We can create scenario analysis. So we try to provide a menu for people so that they're only paying for what they really need. And then we're just helping them get through the pieces that they're already familiar with. So that's something that we can do. You can even hire people by the hour as consultants so they can just review your work. So there are a lot of ways to use expertise from people that have worked at the Big Four, that have worked at the larger companies, but that now, for example, are working for these smaller, kind of slower middle market type firms. So it's a space that I didn't know too well, and I've met a lot of wonderful people with a lot of great expertise that are starting their own practices, and so it's you can take advantage of their lower rates for at least a few years.
Fantastic. I would like to ask you your personal point of view on the following question. What is the major misconception in your field? You're doing M&A, you're doing valuation, you're doing forecasting, that kind of misconception that you strongly disagree with?
So a misconception that I tend to disagree with is that finance has to be complex. So that's one of the things that I try to explain to people, right? Ultimately, you want to start simple, you want to start small, you want to start with the very basic concepts of supply and demand, and then work your way up to more complicated products. For example, if you're a business that is worried about the price of gasoline, there are very complex strategies where you can use derivatives and options and forward contracts to hedge your cost. But there are also a ton of simple strategies that you can implement to just make sure that you can, pay for your fleet in the next year. So that's where I sometimes struggle with people, just helping them understand that there's a wide range of options and you don't necessarily have to go to the most complex one immediately.
Absolutely.
You can start small, you can start simple, and forecasting is the same thing, right? If you're trying to build a forecast, I think the first thing to do is understand the market. How big is the market? How much of that market can I reasonably expect to take over? And do a very simple forecast, right? What's my revenue? What's my cost? What's my net profit? But you can go a layer deeper and now start a piece by piece price times quantity type model and build up that revenue from a more sustainable basis. Now you can think about your salespeople. How many salespeople will you need? Will the products need to be different for your different market segments, right? You can complicate these models, but start simple, work your way up. Don't start at the top with the very complex things. That's what I always tell people.
Mm-hmm. Are there any kind of emergent trends or developments? Of course, we're living in the world of AI. Everyone is talking about AI, but I don't know, maybe in finance is still something else. Are there any emergent trends in development in your field that you kind of would like to share with us, or that small business owners should keep an eye on?
Yeah, absolutely. So the most important one for me, obviously, is AI right now. I think it's currently a bit misunderstood of what it can truly do. Where I see it helping people is in speed of delivery. We're starting to use AI to increase the speed at which we can gather information. And most of the time, it'll give you the correct information. You have to make sure you're careful about that. But in businesses, one of the uses that I see it having is automation. So it's not the same to grow your revenue by adding one more person, right? So you grow your revenue 10, you add that person, they cost you 5. And then the next person adds 10, they cost you 5. The next person adds, and they cost you 5. That's growth, not scale. And so if you can use AI for that first person to, instead of creating 10, creating 15, and then the next one, again, instead of creating 15, creating 20, and you can automate processes and you can create ways to increase the efficiency of people, that's where you're truly going to get value, right? You scale your revenue beyond what your costs are increasing, and that's where I see a lot of value being added. Even in our company, we used to have a lot of analysts, and we're slowly, decreasing the analyst pool because I can have ChatGPT rework my writing, right? I can have ChatGPT come up with a list of similar companies, things like that, where it's small increments of speed, but it's really helping us do things a little bit faster.
Yeah, just today, I think I read it somewhere that this AI revolution will probably get rid of about 1/3 of workforce within next 5 years.
That's a lot. Yeah, I think in the next 5 years it might even accelerate further, right? We're seeing a lot of AR coming about. Even it was something funny that happened, but when I went from 1 screen to 2 screens, my productivity increased, right? So if I can go from having 1 analyst to having 2 analysts, technically with my AI, I'm increasing my productivity as well. So that's very exciting for me, and I think it's only going to get better from here. And the speed at which it's happening is incredible too. So I'm excited about it.
Absolutely, yeah, yeah. So, so if we summarize our interview, if someone who is listening to it would like to walk away with one or two major takeaways, what would it be?
So the first takeaway again is forecasting is a necessary evil. Use it. Your GPS signals or your KPI tracking. Again, what isn't measurable isn't actionable. So track everything that you possibly can. And then lowering risk matters a lot for business valuation. Not only as you're growing your business, but when you're going to sell it. The secret is always having long-term contracts, diversified pools of customers, and segmented customers with differentiated service. If you think about selling one-off classes versus selling subscriptions or selling software how we used to buy Office 365 in a package. It was Excel 2003 and then Excel 2007. It was a single sale, but now we can buy the subscription, and that has increased the predictability of cash flows and decrease risk as a result of that. So lower discount rates means higher value, and anything you can do to lower your risk will directly influence your value.
Yeah, so the SaaS model is very kind of promising, even for service providers, not a software, just to sell a subscription instead of just one-off projects, right?
That's exactly right. If you can figure out a way for example, consulting companies to sell subscriptions to either platform or a model or a tax advisor, even if it's an AI tax advisor where you're inputting the data, you can create a lot more predictability again in the cash flows than having one-off projects. And it seems so obvious now, right? Every company is a SaaS company, but in the past, every software piece was sold as an individual product, and now that's almost forgotten, right? But a lot of other industries can do the same, and diversifying that client pool is tremendously important as well.
Yeah, yeah. So I saw that also the valuation, this multiplier differs by type of company. For example, for small consulting that using all the models, maybe 1, 2 or something multiplier, but for SaaS with stronger growth, it's maybe 10 or even more multiplier, right? When you sell company.
That's exactly right? So multiples are a direct relationship to risk and growth. So if your growth is higher, your multiples are automatically higher. But if your risk is lower, your multiples are also automatically higher. So that's again the one that gets forgotten a little bit, right? That risk plays just as an important part as growth.
All right, that's fantastic. So those were all my questions. Perhaps if I forgot to ask you something, would you like to add anything that will benefit our audience?
Yeah, I think the thing I would like to add is people are sometimes afraid to ask professionals for help. But I recently tried to build my wife's clinic website and very quickly realized that even though there's a ton of platforms of do-it-yourself and things can be somewhat easier to do now, at some point I'll probably have to ask a professional to help me with the design and to make it look really good. And they've been doing it for 10 years, right? 15 years sometimes. And that's what I think sometimes people forget, that someone who has seen 100 transactions might be able to provide some value to you if you've only seen maybe a couple. That's something that I think people should just be a little bit more mindful of. And then there are real tools, right? If you're a board of directors, there are things like a fairness opinion where the company providing the fairness opinion can provide an independent opinion of value, can help you lower your risk of being sued, and can actually help you be better informed as you're making an acquisition and making a decision for a company where, again, the board of directors is a pretty important part of that process. So that's something we offer, fairness opinions, for example, and anybody who needs that for a transaction, even if it's a board of managers, we are always happy to help in those matters.
All right, Jordi, thank you very much. And I hope we will see each other probably in more interviews, because we are a global risk community. We are inviting people like you, thought leaders and executives on our platform to discuss emerging trends. So You are happy. You are welcome to join our community at globalriskcommunity.com. And also, perhaps in a few months, we will discuss with you another topic, if you don't mind.
Sounds great. Well, thank you so much for having me. I enjoyed my time here, and I'm so happy that I was able to talk to you. I love your community, what you've done for the risk community. It's pretty amazing. So I'm pretty honored to be here. Thank you so much.
Thank you, Jordi. Bye-bye.